Hello everybody and welcome. We are from Pantheon and today we are going to present to you on private equity and Pantheon International PLC, or PIP for short, which is the investment trust that's advised and managed by us. Before we get started, I would like to draw your attention to the disclosures and information on this slide about the risks associated with investing in private equity. They are important, so please do take the time to read them. First of all, let's introduce ourselves. My name is Vicki Bradley. I have been with Pantheon for 4.5 years, and I look after the investor relations for PIP. I am joined by Helen, who is a partner at Pantheon and has been with the firm for more than 16 years. Helen manages PIP and also heads up Pantheon's European investment team. We are also joined by Tanu Chita. Tanu is a principal in Pantheon's investment team and is responsible for managing PIP's investment activities. He has also been with the firm for more than 16 years. During this presentation, we are going to talk about the private equity markets and why we think it's a good place to be, the characteristics of PIP and what it offers to investors. And as you would expect, we will talk about the impact of COVID-19 on our market and how PIP is positioned to get through the crisis. So let's get started. I'll kick off by introducing Pantheon, which is the manager of PIP. Pantheon was formed in 1982, so has been around for nearly 4 decades. We started out in London, and that's where our headquarters are, and we have grown into a global business with 8 offices spread across the Americas and Asia. We have more than 300 staff based in the regions, and we manage over $49 billion of assets for more than 600 clients, one of which is PIP. Pantheon started life as a private equity firm, and that accounts for the majority of our assets under management. But we also manage strategies across infrastructure and private debt. Over many years in the business, we have built up scale and significant expertise, and that's critical as our role on behalf of our clients is to seek out the best private equity firms globally and invest in their funds or directly into businesses alongside them. As we will go into later, it's not easy to access the best private equity deals. You need to have deep, long-standing relationships and access to information that others don't have. Our large team of investment professionals, many of whom have been with the firm for over 20 years, gives us just that. As I mentioned at the beginning, we have been around for a long time, so have been through multiple economic cycles, and we believe that that is an important point at the current time. As a client of Pantheon, PIP has access to this vast platform and experience. So on to PIP. PIP has been around a while as well. It's IPO'd in 1987 with £12 million and has grown to become a FTSE 250 company. It has net assets of £1.5 billion. And since it was formed over 30 years ago, it has delivered average net asset value growth of 11.5% a year. That performance is net of fees. And as you will see from the table, the NAV has outperformed the public market benchmarks that we use over the near, medium and long term. The share price has been caught up in the recent public market volatility, but equally over the long term, it has outperformed and delivered double-digit returns. PIP has continued to be a top-rated fund, and we believe that this is due to the access it has to Pantheon's platform, as well as the compelling attributes of the private equity market. I'm going to hand over to Helen now, who will talk about what those attributes are.
Thank you, Vicki. Hello, everyone, and thank you for spending time with us today. We're now going to spend a few minutes reviewing what is going on in private markets, identifying trends and the challenges and opportunities that these represent for investors. You're probably aware of the headlines, both good and bad, that private markets attract. On the one hand, attention has been focused on the fact that the public market universe, in terms of the number of public companies, has been shrinking, while private markets have been growing. On the other hand, certain commentators worry about this expansion of private markets and whether there's too much money chasing too few deals. I'll address this topic and dig into the reasons why we believe that private markets will continue to grow while public markets continue to shrink. So first of all, let's look at the historic growth of private markets. This chart shows assets under management in the main categories of the private market industry. Private equity, which is in dark blue, private infrastructure in light blue, private debt in mid blue, and natural resources in yellow. The industry has been growing at a steady pace for the past 20 years. The segment that PIP invests in is private equity, and at the end of 2019, private equity assets under management was over $4.3 trillion. Now, this sounds like a lot of capital, but let's put it in perspective. In comparison with listed markets, this is still small. In fact, even in the most sophisticated private equity market in the world, which is the USA, private equity only accounts for about 1.5% of GDP, whereas public market cap to GDP, which is known as the Buffett valuation, stands at over 150%. So the private equity market is still relatively small, and the opportunity set for private equity is increasing. And these numbers prove the point. You can see that over the past 10 years, the number of publicly quoted companies, which is the dark blue line, has been shrinking by just over 3% per annum, while the number of private companies, in light blue, has been growing by almost 7% per annum. Why is this happening? Well, there's a variety of factors, but the main one is that many fast-growing companies are making the choice to IPO later, or even deciding not to go public at all, since they can raise capital in private markets, which can be seen as more desirable for many reasons. Also, there's many public-to-private transactions occurring as private equity takes larger companies off the market. And finally, public companies may merge, which again reduces the number of quoted firms. The net result is that the universe of public companies is becoming smaller, comprising larger, older, and more slowly growing businesses. And in fact, private markets are providing access to the faster growing, younger, and more innovative companies. Growth is really occurring before an IPO, and it's being financed by private capital. I mentioned that companies are choosing to remain private for longer, and here are some well-known examples. Amazon, Google, and Facebook. Amazon only spent 3 years as a private company before going public in 1997 with a market cap of $626 million. Google spent 6 years as a private business, IPOing in 2004 with a market cap of $28 billion. Facebook went public in 2012 after 8 years as a private company with a market cap of $110 billion. As these companies stayed private for longer, by the time of the IPO, they had reached greater scale by revenue and market cap, and the impact on investor returns is evident. An IPO investor in Facebook, which raised $2.84 billion at IPO, could not replicate the returns of an investor in Amazon's IPO. Facebook's growth and most of the returns were made prior to the IPO. So the takeaway here is that companies are able to grow and increase in value substantially before the IPO. And as Andrew Boyd of Fidelity said, today's pre-IPO market has become the IPO market of the past. But what is private equity? Well, private equity covers a range of stages in a company's development. And there are various types of private equity. Private equity is really simply privately negotiated investments in privately owned companies. They can be founder-owned, young entrepreneurial businesses, or family-owned companies. They can be divisions of larger companies that have been spun off, so-called corporate orphans, or unloved public companies. Venture capital tends to refer to early-stage funding with emphasis on very high growth sectors, for example, information technology and healthcare. No leverage is used, and these businesses tend to be higher risk. The time horizon is over 5 years. A good example of a venture capital-backed business would be Spotify. Growth stage equity consists of minority investments to fund companies at a later stage of growth. Again, leverage is usually not used, and the time horizon is over 5 years. A good example here would be Just Eat. Buyouts are control investments in well-established businesses, and they use debt financing. They can still be in high-growth sectors, but they can be in a range of different industries. They tend to be less risky than venture capital and growth. And a good example here would be the buyout of WorldPay, which was a division of the Royal Bank of Scotland. Special situations is a smaller category consisting of distressed debt with equity-like features. It can also comprise turnarounds and investments in specialist sectors such as energy. It tends to provide higher IRRs but lower multiples. Whatever the segment of private equity, there are similarities in the techniques and tactics used by managers, shown in this slide. One of the reasons why private equity has become a more popular way of funding smaller growing companies is because private equity managers do not just bring capital to their portfolio companies. They bring deep expertise and experience in building businesses. Some of these tactics include practical help in improving operations, for example, optimizing supply chains, or in assisting with the digitalization and tech enhancement of companies. But they also have a hand in improving management, adding experienced people to teams and to boards. And because they have a long-term view, they can invest in growth projects that could be less well tolerated in a public company because they may depress short-term earnings or require considerable capital. So, for example, they can make add-on acquisitions and then extract synergies or undertake new product development over a long period of time or grow into new geographies. So let's bring this back to PIP and some practical examples which illustrate how managers add value. First of all, buy and build. Several of PIP's managers specialize in this strategy, targeting an investment in an initial platform company and then completing a series of acquisitions to build scale and make the company potentially more attractive to a trade buyer. A good example here would be our investment in Salad Signature that was backed by IK Investment Partners. I've already talked about the importance of operational expertise, and nearly all of our managers have an operational focus, improving the way that portfolio companies are run. An example here would be Profi Rom, which is a chain of convenience stores that was backed by one of our managers. Many of our managers invest in very high-growth sectors such as information technology and healthcare, which benefit from secular growth trends and significant tailwinds. And we've seen this play out even during the COVID-19 crisis, with segments such as remote working, e-commerce, and specialty pharma being particularly resilient. A good example here in our portfolio is Allegro, which is essentially the Amazon of Poland. On top of this, sector specialists in various industry sectors are able to bring their knowledge and deep networks of contacts to bear, and they use similar playbooks in different companies. An example here would be Visma, which is a software company based in the Nordic region. Finally, resilient companies that can go through recessions are a theme for many managers. They can specialize in defensive sectors and target companies which have a high degree of recurring or contracted revenue. Or they may indeed be in sectors that show a great deal of resilience naturally. And a good example here in our portfolio is a company called Velvet Care, which is one of Europe's largest manufacturers of tissue paper. It is clear that companies benefit from private equity ownership, but why do investors continue to pour money into the sector? Well, it's all about performance. And it's clear from this chart on the left that it's the risk-adjusted returns which have been very attractive and which continue to attract investors. This graph shows returns, the median net IRR versus risk, the standard deviation of the net IRR, by private market subsegment. The big dark blue dot shows overall private equity returns, around about 12% net, versus standard deviation of around about 17%. Buyouts are shown by the dark blue circle, showing slightly higher returns and lower standard deviation. The chart on the right-hand side confirms that the median net return, which is the blue diamond, is around 14%, for example, for buyouts. However, you can see immediately one of the issues with private equity. The dispersion of returns is high. Top decile returns for buyout hover at around 30%. The top quartile is around 20%, but the bottom quartile is around 7.5%. So the interquartile range of returns is massive. And if you look further along the chart at venture, you'll see that the interquartile range is even larger. It's probably over 1,500 basis points. So this shows, with the dispersion of returns, that manager selection and indeed deal selection is absolutely critical in private equity. In summary, we believe there are many reasons why the private market universe will continue to expand even as public markets shrink. Private markets will continue to expand as young, growing companies find the private equity model a more attractive form of ownership. Investors in search of higher returns in a low-yielding world and of diversification will continue to pour capital into private markets. And private equity is continuously evolving, finding new targets and new ways to add value. The COVID-19 crisis has shown the critical importance of hands-on management and how fast, agile, and nimble private equity managers are able to work with their companies even in this challenging environment and to identify new areas to invest in. I'd now like to turn it back to Vicki, who will talk more about how investors can access private equity.
Thank you, Helen. Well, many institutional investors have long recognised the merits of private equity, As you can see from the stats here, those that invest in the asset class indicated in a global survey that they expected to increase their allocation. In fact, in a more recent survey carried out by Preqin, 95% of surveyed investors said that they intended to maintain or increase their private equity allocations over the longer term. On the next graphic, you'll see that over a third of institutions aren't yet allocating to private equity, and, as is shown on the third graphic, those that do are not reaching their target allocations. So the indications are that investor appetite for private equity investments continues to grow. If we think about the types of institutions that typically invest in private equity, they tend to be larger institutions, such as the ones that you can see listed here. They invest large amounts of capital, usually a minimum of $10 million, although in some cases the minimum investment can even be $20 million. They invest into the fund of a private equity manager, or general partner, as they are commonly known, who will then in turn invest that capital into a range of businesses. And many of those businesses will be ones that we see and interact with in our everyday lives. As Helen mentioned, private equity is a long-term investment, and therefore capital can be locked up in a fund for 10 years, sometimes longer. As you can see, this gives the private equity manager or general partner time to seek out businesses for investment and help those businesses to grow and realise their potential before selling them and returning the proceeds to their investors. But not all investors are able to commit the minimum amount of capital that is required, or for the minimum period of time. We've talked about the difficulty of accessing the best private equity managers, and many investors simply can't, either because they don't have the relationships or because they are locked out for regulatory reasons. Finally, investing in private equity and doing it well is resource intensive, and it requires skill and expertise. For investors facing those kinds of barriers, a closed-end fund like PIP offers the opportunity to access private equity in a way that is simple and can work for them. We think that investing in private equity via a closed-end fund offers many benefits to shareholders. First of all, the shares of a closed-end fund are traded on a stock exchange, in PIP's case the London Stock Exchange, just like any other listed company shares. In other words, they offer liquidity even though the underlying assets themselves are illiquid. The fund invests in private equity managers' funds, just like those other large institutional investors that we saw earlier. So, in PIP's case, shareholders are getting access to the same high-quality private equity managers and investments as Pantheon's other institutional clients. Unlike with an open-ended fund, investors can exit by selling their shares via the stock exchange, and the fund itself does not have to sell any assets in order to meet redemptions. Governance is an important feature of the closed-end structure. Tanu will talk about PIP's board a bit later in this presentation, but PIP's directors come from a range of backgrounds and they are independent. Their role is to ensure that the company's strategy serves shareholders well. And finally, closed-end funds can buy back their own shares. And indeed, PIP has done this opportunistically for investment purposes. So we have talked about what we think private equity offers to investors and how to gain access simply. Now let's turn to some of the current themes affecting PIP's portfolio, which of course includes a discussion on the impact of COVID-19. Over to you, Helen and Tanu.
Thank you, Vicki. All this sounds good, but how has the COVID-19 crisis affected private equity, and where are we now? Well, let's wind the clock back. At the end of 2019, the global private equity and venture capital industry was in a good position. Fundraising was at a healthy level in terms of value, around $600 billion a year, similar to levels in 2018 and 2017. Global investment activity was actually around $650 billion in 2019, and this activity has hovered at the same level for the past 5 years. Realizations had also been strong at around $600 billion a year for several years as managers took advantage of healthy exit markets with high valuations, acquisitive buyers, and supportive debt markets. But managers were preparing themselves for the downturn which they knew would come given the length of the bull market. No one knew what the trigger would be, and certainly no one expected that trigger to be a global pandemic. However, GPs had been readying their portfolios and their own firms. They'd rushed to fundraise while times were good and amassed significant war chests. They took advantage of strong exit conditions to sell portfolio companies. They'd invested in their own firms, adding extensive sector expertise not only in their investment teams, but also increasing the number of people in their portfolio management teams, adding supply chain, procurement experts, digital marketing expertise, and critically, capital markets teams. They'd improve portfolio companies' financial positions, strengthening capital structures through refinancings, lowering financial costs, and pushing out maturities. And they'd prepared extreme downside cases, stress testing recession scenarios. Also, they'd been investing in businesses with multiple levers for value creation, not relying solely on multiple expansion on exit, but expanding companies through both organic and acquisitive strategies. But what's happening now? Well, our managers have taken rapid action with their portfolios. And that's one of the advantages of private equity. Sharp attention to detail, heightened governance, more and increased frequency of contact between the portfolio manager and the company management, refocused board agendas, crisis committees, sharpened key factors, sharing of best practice, and use of additional resources. And first of all, the general partners triage their portfolios. They classify their companies into low, medium, and high impact categories. And then they focus their attention immediately on three critical areas: workforce health and safety, preserving liquidity and tightened cash management, and operational management. At Q1 2020, portfolio valuations were down, on average in the high single digits, although the ranges between managers were quite large, between 0 and minus 25% for individual GPs. I should note that it's typical for valuations in private equity to be dampened versus public markets on both the downside and the upside. New deal activity and exits slowed at the end of Q1 as GPs focused on portfolio management, although several large pending transactions still closed. And as for fundraising, some high-profile funds closed in Q1 at their targets or even at their caps. But looking forward, what are GPs doing at the moment? Well, they're now moving not just from the defense side of the equation, but really into offense, seeing how they can add value to the portfolio companies, increase acquisitions and mergers activity, and really add value. In summary, our private equity managers are working hard to ensure the best outcomes for their investee companies. I'd now like to turn to an essential topic, responsible investment, and talk about ESG and responsible investment in the context of COVID-19. We've been impressed through our discussions with our managers how swiftly they've reacted to the essential elements of responsible investing through this crisis. First of all, as I previously mentioned, prioritizing employee health and safety. In some cases, learning from earlier experience if they had companies in Asia about what worked and then what didn't work. Secondly, supporting their companies with significant resources and capital. And thirdly, stepping up their oversight of companies, really heightening governance and focusing on not just the survival, but also the thriving of their businesses. In addition, both the managers and their portfolio companies have become involved in the relief effort, either directly because of their operating activities, for example, by developing vaccines and testing, or indirectly by donating equipment and services. And just to give some examples, one of our portfolio companies donated beds and mattresses to New York City hospitals. Another offered spare capacity in intensive care units to the state hospital system. Others have donated food or lodging for key workers. And aside from physical goods, both software and services have also been donated by private equity-backed portfolio companies. And the private equity managers themselves have donated tens of millions of pounds, dollars, and euros to support local communities and the families of portfolio company employees. We believe that much of this increased responsible investment effort will continue in the post-COVID-19 world. And now, turning back to Pip, I would like to hand over to Tanu.
Thanks, Helen. I'm going to talk about how we've managed the portfolio and balance sheet to grow the company and help navigate any uncertainty. In the 33 years of Pip's existence, the company has achieved strong performance by investing in some really attractive private investments. And as Vicki outlined earlier, has demonstrated significant outperformance against the public market benchmarks while traversing multiple economic cycles. This has been due to, firstly, our focus on selecting the highest quality private equity investments. Secondly, our risk-managed approach to ensure optimal diversification by a variety of factors, including geography, sector, manager, and size of company. And thirdly, prudently managing the balance sheet has helped to buttress PIP's performance, regardless of the environment. The approach that we've taken to environmental, social, and governance matters has been embedded within our investment framework since 2007, when we became one of the first private equity signatories to the UN PRI, which Helen will discuss later. And finally, we have a board that is extremely talented, experienced, with a diverse set of backgrounds and skill sets. Our board has provided multiple perspectives and, with an independent challenge, has helped ensure optimal management of PIP for our shareholders. The strength and depth of our relationships with private equity managers has been the bedrock of our business, ensuring access to the best private equity opportunities globally. Our portfolio is weighted to the US, which has historically been the deepest and broadest market for private equity, and has been remarkably resilient whatever the economic environment. PIP also has exposure to some really exciting managers in Europe, Asia, and the emerging markets, which provide a diversified global approach. We have an emphasis on small, mid-cap, and growth companies, which provide access to the majority of the high-growth opportunities that we seek using the thematic framework which Helen discussed earlier. We will also access high-growth opportunities in the large buyout space, but expect that to be similar in quantum to today's exposure. As Helen discussed earlier, we seek to access the highest growth sectors, providing a secular growth trajectory. Sectors are showing differential impact from the COVID crisis, but there are differences by underlying subsector level. In the short term, as people work from home, those companies providing video conferencing services, for example, will likely do well. Other companies, some of which are represented in our portfolio, are expected to benefit, such as those in the software as a service sector, particularly where they are providing internet security services or helping small and mid-sized businesses manage their data and systems online. A great example of the latter is Abacus, the number 5 company in PIP's portfolio, which helps legal and accounting firms hold their data in the cloud. Various healthcare companies provide a need-to-have rather than a nice-to-have service or product, and will in the long term benefit from demographic trends. User Pharma, the largest company in PIP's portfolio, is a specialty pharmaceutical platform focused on oncology, pain relief, and critical care, i.e. need-to-have treatments. Among other healthcare subsectors, we have invested in companies operating in the dermatology and ophthalmology sectors, which may see short-term impact from COVID. Nevertheless, our managers are in active pursuit of attractively priced bolt-on acquisitions, and moreover, such healthcare appointments can only be deferred for a certain time, resulting in likely pent-up demand as we emerge from the crisis. The most significant impact has been on consumer companies, with investments in the restaurant and hospitality sectors especially impacted, to which PIP has a low exposure. Conversely, the consumer staples subsector remains robust, with businesses in our portfolio such as tissue paper manufacturing, which Helen referred to earlier, and fruit distribution experiencing strong growth. We entered May with a well-positioned balance sheet, as portfolio and available financing covered our undrawn commitments by 3.2 times. We exited May with an even stronger balance sheet, as the facility size was increased from £175 million to £300 million, providing very strong protection in the face of uncertainty. When added to the £114 million in balance sheet cash, as at 30th of April, PIP's total available liquid financial resources, taking into account exchange rates, were equivalent to £420 million. When compared with the company's unfunded commitments of £530 million as at 30th of April, this represents formidable coverage and underlines the company's ability to comfortably finance its unfunded commitments, even if the current uncertainty is prolonged. PIP is managed in line with the highest standards of corporate governance. The independent board is truly a mini parliament of all talents, comprising extremely well-qualified, experienced professionals from a variety of different sectors. With the appointment of Dame Sue Owen and Marianne Sieghart, we now have 3 women on the board, underlining the board's leadership in diversity. Together, the board provides robust challenge on the performance and formulation of PIP's investment and marketing strategies, and ensure that shareholders are always first. Furthermore, there is a strong alignment with all directors owning PIP shares. I'd like to turn it back to Helen for the summary.
Thank you very much, Tanu, and I'd like to summarise our investment approach now and talk about PIP and its benefits and leave you with 3 key points. First of all, private equity works because of a number of factors, but the long-term investment horizon, strong governance and alignment of interest have a lot to do with the success of what is an expanding asset class. As you've heard from Tanu and also from Vicki, we also benefit from alignment of interest, a focus on long-term value creation, active portfolio management and strong governance at PIP, which all adds up to good performance. Secondly, ESG factors are extremely key. They play a strong role in the way that our portfolio companies are managed and in the way PIP itself is run. Pantheon, PIP's manager, has outstanding ESG credentials and is a highly responsible investor, having been awarded an A+ by the UNPRI in 2019, and in fact being one of the first private equity signatories to the UNPRI back in 2007. Thirdly, although private equity can appear to be a difficult to access and complex asset class, and perhaps the preserve of large institutions like pension funds, as Vicki mentioned, there is a way for a broader set of investors to gain access to the benefits of private equity investing. PIP offers a way into private equity with the advantage of being listed, so investors can access private equity without being locked in and without the complexity involved in committing to traditional private equity funds. So summarising the benefits of our investment approach, it can really be encapsulated in 3 words: responsible, growth-orientated, and accessible. And PIP's results over its 33-year history have been excellent through multiple market cycles. This chart shows our annual NAV growth and share price growth since 1987 and the long-term performance that's been generated. And this has been done through a balanced and diversified portfolio, providing access to private equity on a global basis, as Tanu explained, participating in high-growth sectors that can be difficult to gain exposure to through public markets. PIP does all the hard work in terms of accessing top private equity funds and underlying private companies in a cost-effective way, and investors can gain access through buying just one share in the trust. Finally, PIP is managed by Pantheon, which has an excellent reputation and is known for its responsible investment credentials. Thank you very much, everybody, for listening, and I'd like to turn it over to Vicki.
Thank you, Helen, and thank you, Tanu, and thank you to all of you for joining us today. We hope that this presentation has given you a flavour of what the private equity world has to offer. You'll find a lot more information on the website.